Hello, fellow Robo Capitalists. Hope you're well. So, something I have been watching very closely over the last probably 3 or 4 months is when is bad news going to be bad news? Because you guys have seen this cycle many times. You know how this plays out. It's always that bad news is good news because that means the Fed's going to lower rates or they're going to do more quantitative easing or whatever it is that the market believes the Fed does to produce more liquidity to make the S&P 500 just keep going straight to the moon. But what you have to look out for, two things. Number one, you have to realize that the stock market takes the stairs up and the elevator down. So it's a machine that is meant to catch as many people off guard as possible. The more I study economics, the more videos I do, the more I get into this topic, the more I'm convinced that the mechanics of the market is set up to make sure the majority of people lose money. It is what it is. So what you have to do as a prudent investor is you have to wait and look for the signals that bad news is all of a sudden becoming bad news, because we've got bad news being good news, and it takes the staircase up, staircase up, staircase up. You know, a little bit worse unemployment rate. Oh, well, that's great because that means the Fed's going to raise rate. The stock market goes up by 500 points. And then the CPI comes in low. Okay, well, this means the economy is slowing. Well, fantastic. That means the Fed's going to go ahead and decrease rates, even though there's a higher probability of recession. You see all these things that normally you would say, that doesn't sound like that's good for the economy. That sounds like that's bad for the economy, but it doesn't matter. So the key is trying to figure out when we make this transition, when we make this paradigm shift from bad news being good news to bad news being bad news. And if you guys, we don't even have to go all the way back to the GFC. Let's just go back to March of 2020. Remember that? Remember every single thing that we were hearing about the cerveza sickness. They're like, oh, that's crabby. Heck, even if this is a little pandemic-a-rooney, doesn't really matter because that just means the Fed's going to raise rates. And what happened in February? In fact, let's go to a chart. This will be, I wasn't even going to pull up a chart of the S&P 500, but I think this is a great opportunity to get a visual here of exactly what happened, because this is the way these cycles always play out. So let's go to the S&P 500. Let's go to chart. And let's go back 5 years. And right here, this was February of 2020. In fact, let's just go back even further. And look at this. Remember, the curve inverted in August of 2019. So right around here, August, it's tough to get this exactly here, but we're right around 2977 on the S&P 500. And going into February, let's see. Now let's go ahead and zoom in so we can get an accurate number. Going into February, even the middle of February, we were at 33. So the S&P 500 was up about 400 or 500 points from when the curve inverted. And remember, we had the repo blow up in 2019. So let's go back to the S&P 500. We had the repo blow up. That was right around here, the S&P 500 at 2992. And then what happens? The Fed does QE, but don't call it QE. Remember that? And the market thinks, well, that's liquidity. That's liquidity. Now, I would argue that it's not, but it doesn't matter what George Gammon believes. What really matters is what the market believes, and therefore what the market does. So they go in and buy stocks. Risk on, risk on, risk on, because now all of a sudden the Fed is taking a dovish stance. They're more accommodative with the QE. And then, well, maybe if this cerveza sickness thing gets worse, well, that's great, because then the Fed will lower rates and market just goes higher and higher and higher and higher and higher and higher, to the point where, whoa, wait a minute. Then in March, right at the beginning of March of 2020, we had that shift, that fundamental shift, where the news got so bad that now all of a sudden, bad news is no longer good news, it's bad news. And then the market hits that air pocket and takes the elevator down. I'm not saying that's what's going to happen in the next week or 2 weeks or month or year. I mean, who knows? It's impossible to time these things. But what I am saying is you have to look for these changes in how the market is digesting the data and how it's responding to the data. And I think we may have seen a shift. Here's what I'm referring to. Let's zoom in on the last month in the stock market, S&P 500 here. And we're going to go back to this, let's say the 20th of May, and we're right around 5,300. Now, the stock market has gone down since then, S&P 500. Let's just call it by 100 points. So we're at 53.21. We're right around 52.69 as we speak. So not a crash or anything, but it's down slightly. Okay. Well, why this is important is because look at what has happened to bond prices, or maybe more specifically bond yields, during the last, let's say, month. And for this, we're going to look at the 10-year. This is a proxy for yields. And if we zoom in on the last month, especially the last couple weeks here, I mean, the yields have crashed. That is a crash. When you've got yields on the 10-year in basically a week or two going down by 30 basis points, that's a big deal. So my question would be, all right, well, the market is pricing in lower interest rates. That's what we can see by this, the action in the 10-year Treasury. You would assume that means stock market up. But we're now seeing the opposite. And it's not just in the stock market. We've seen all of these commodities, or not all, but a lot of commodities rip higher on this narrative of reflation. You know, the yield curve is dead. We've successfully avoided a recession. In fact, we've successfully avoided even a soft landing. We're going to have a no landing. And we're going to see the market rip higher and higher and higher. And China is coming out of their doldrums. The Germany, their manufacturing base is getting much stronger. Look at the price of copper. It's mooning. All of these things that would lead you to believe that this is reflation. Yet all of a sudden you hit a brick wall and the 10-year Treasury goes from, let's just call it 4.7 straight down to 4.3. And during that time, you get oil pretty much doing the exact same thing, the price of oil. And what's really amazing about oil, yikes, look at this. What's amazing about oil is they have done so many supply cuts. You just got to ask yourself, where do you think the price would be without those supply cuts? And if they're propping up the price, let's say it should be at, or it otherwise would be at 45 or 50, whatever. Okay, well, that means that the economy is being taxed effectively $25 a barrel. And that's not resulting in inflation, consumer prices going up, although it may impact the CPI. Eventually, that leads to disinflation, and that increases the probability of a recession. Why? Because you're having to rob Peter to pay Paul. Why was the 1970s different? Because we saw the money supply go straight up. Where right now, the money supply is down over the last 2 years, flat over the last let's say 6 months or so. But it's actually down, something we haven't seen since the 1930s. So now we're starting to see yields come down, but we start to see stock market go down as well. This shouldn't be happening. Yields down, stock market up. And then we're starting to see oil come down. We're starting to see, let's see, copper, I believe, obviously it was way, way up. And then that hit a wall and has retraced big time over the last 2 weeks, I believe. Let's look at a month chart. Yeah, it's really, wow. Yeah. Was it $5.10? Now is down at $4.55. So we see that. So this is not what you would expect if the reflation narrative was going to pan out. So I think the last thing that I would encourage you to watch to try to determine the probabilities of this paradigm shift that we've been talking about, where bad news goes from good news to actual bad news, is the dollar. So let's go over to USD. I'm just going to do USD. We'll do CNBC. Just keep charts the same here. Okay, that's not what we want. Let's do that. Let's just do the DXY. I know this isn't perfect, but we'll just use this as a proxy. Okay, 104. So let's go back to this 1 month chart, and we have seen this go down. So this is what you would expect. If the 10-year yield is going from 4.7 down to 4.3, because this is basically trading on the expectations of interest rate differentials. So if theoretically, if Japan is increasing interest rates and the United States is decreasing, now I'm talking about the Fed, I'm not talking about the 10-year. Then the argument goes, well, capital is going to flow into yen assets, and therefore there's going to be more demand for yen. It's going to appreciate relative to the dollar, or vice versa. Now, from what I've seen, that is true, but it's only short term. There's obviously thousands of variables, and the variable that I think is, or if you look at this as cross currents, we talk about that on this channel all the time. Cross current that would likely overwhelm an interest rate differential is if you did have a recession, or the global economy slowing down to the point where the mainstream media was actually acknowledging it, and you see the unemployment rate go up to 5, 6, 7, let's say, then likely you would see a flight to safety that would include the dollar, that would overwhelm the expectations of interest rate differentials. So the last shoe to drop, so to speak, once we've seen that now the stock market is going down, even though yields are going down, assuming that trend continues, then once you see yields go down even further, but yet you see the dollar go up instead of down, that's when historically you're getting to the point where you know bad news is turning into bad news. All right, guys, enjoy the rest of your afternoon. As always, make sure that you're standing up for freedom, liberty, free market capitalism. We'll see you in the next video.